and any indications of easing of the monetary policy will be watched for closely. But here you go. There's the first tick on the index. Very quiet, but we like that because what we're doing is consolidating our gains at the 20,900 mark. Mid-cap index is up in the green, 125 points in the green. So the market is abuzz with ideas in the broader markets. We'll get to that in a bit. For now, the big stock on our radar is Dr. Reddy's. It's down 5% on the back of the US FDA observations, and some of them could be severe according to analysts. So Dr. Reddy's is the one that's taking it on the chin this morning, down about 5-odd%. The other one that's getting knocked down is Wipro on the back of another senior exit. So Wipro is down about 1-odd%. Apart from that, names like Sun Pharma, Cipla, so the entire pharmaceutical space not looking that great this morning, just sulking a bit. Then you have, Divi's Labs, Bajaj Auto, Titan. Remember, auto stocks just taking a bit of a breather. It's been a phenomenal run for the auto companies. So you have Bajaj Auto, M&M that are all just taking a bit of a breather this morning. But what's leading from the front is ONGC, up about 1%. Coal India is doing very well. It's been the strongest stock in the PSU basket this year, 60% higher on Coal India this year. SBI is coming back with a vengeance. Tata Motors, Tech Mahindra, BPCL, Kotak Mahindra Bank, Axis Bank, all of them looking quite good this morning. So the Nifty just about consolidating at the 20,900 mark, but plenty of stocks in the green. You were talking about IRDA, 6% higher on IRDA this morning, so there are plenty of ideas there.
Well, that's right, Sonia. Plenty of stocks actually moving around. GMR Infra, GMR Airports actually, where GQG that bought into that stock. So it had a big run in Friday's trading session. It's higher with 2.5% gains even today. GMR Power and Urban, as we pointed out earlier, well, they were looking at, a probable fundraise. So that's locked in upper circuit, 5% higher. Lloyd's Metals, well, they're talking about expanding capacity, moving towards forward integration. The street likes that. Funding is going to be interesting. For the time being, they're saying it's going to be via internal sources. So that stock as well as higher volumes, though, yet to pick up on that one. 63 Moons, well, that's another stock that's done quite well. That's up closer around 5%, moving from circuit to circuit. So let's see how that one goes. Mascon Dock, they won a big order out there, and the street likes the theme on the whole. That stock as well is up by close to around 4.5%. So plenty of gainers in the broader markets. For the time being, the Nifty is holding with a gain of close to around 10 points. For the broader markets, you have 4 stocks that are advancing, for just 1 stock that's declining.
Okay, well, that's the open as things begin, and it's up. The Nifty is up about 10 points or so. 20,980 is where we start the session this fresh new week. Just a few more names. So Mazgaon Dock is up about 4% or so. That's coming up with decent gains. It's got large volumes in it. IRDA, of course, we just mentioned 6% again. GMR Infra started, I think, about 3% higher. It's 2% up. Friday, of course, GMR saw a big move. By the way, volumes today are humongous. It's coming up as a top volume traded stock across the board in terms of the market. Patel Engineering will come up on your screen. Stocks at about 65, and it's coming up with very strong gains. We got Spencer. Spencer saw a very large move on Friday. I think it was about 6 or 7% higher, another 3%. Saregama is another one we should pull up. MK has initiated coverage on Saregama. Stocks up about 3%, at about 382 now. We got, what else? Anantraj is coming up with 3% again, and BCL Industries 4% higher. So here and there, lots of movers. Adani Total is 3% higher. Stocks at about almost 1,200 now. So it's a positive start, and 3:1 in terms of advances to declines is what you've got going at this point in time. Oberoi Realty is starting about 1% lower. There is a Morgan Stanley downgrade on Oberoi Realty. So stocks at about 1430 coming through. Prestige Estates is down about 1%. That note on real estate is interesting from Morgan. We'll talk more about that later. And I think you've got Suzlon, which starts about 1.25% lower as well. So that's the overall market picture. The big loser, of course, is what's happening with Dr. Reddy's. 6.5% lower at this point, and very large volumes right at the word go.
Even sugar stocks, they're seeing some bit of green. Remember, they've got clonked back last week. Now we'll have to weigh. They're going to be losing out on some ethanol production, but the stocks have already seen a big correction. Though they'll be gaining on the sugar prices as well as the sugar volume. So both of them, we'll have to see how they play out post this big cut that we've seen in all the stocks. So some green just in the pre-open. So I just wanted to highlight that. And Sonia, what else?
You know, HCL Tech, I was just noticing that HCL Tech has hit a fresh 52-week high today. So it's now up almost 32% for the year. Just pull up HCL Tech. And last week, a couple of days ago actually, Morgan Stanley had a price target of 1,400 on the stock. They said that, if you remember, they announced, HCL Tech announced the extension of that partnership with the Nordic-based manufacturing group. And this could be, there's extended scope of services here, more revenue potential. So at a time when Wipro is actually facing a lot of heat because of a lot of exits, right? Senior level exits. At the same time, you have something like an HCL Tech that's hitting new highs. So I guess it's also important in this market to differentiate the men from the boys in that sense, because you can't just buy anything and everything because the market is rallying.
Absolutely, and that's well put. So we got, 20 points now on the Nifty. Stock, we're at about 20,993. Ravi Dharamshi is a market master of the day. He's Chief Investment Officer at Value Quest Investment Advisors. Ravi, good morning. Great to have you with us here on the program. And I think it's a very appropriate time to have you on as well, because you've been a big believer in this energy transition theme, right? New energy, renewables. One of your big ideas has been Praj. We've spoken about this at length in our past interactions. So let me just ask you for your reaction to how you see the change in regulation that we saw for ethanol. No cane juice for ethanol. It's for a limited period, but it's caused a fair bit of anxiety amongst investors, both in sugar stocks and in names like Praj, etc. as well. As a big believer in this theme, what's your take, and what would you do here now?
Good morning, Prashant. Thanks for having me. Without commenting on any particular company, what I would like to say is that this year, of course, a couple of the major sugar-producing states, Maharashtra and Karnataka, have had deficient rainfall. So that is going to lead to a significant reduction in the coverage area for sugar. And that can lead to some sort of a shortage in the future. Hence, government is being proactive by cutting down on the production of ethanol from the molasses route. However, just to point it out, incrementally, all the new capacities that were coming up for ethanol production were already moving towards grain-based production. And in fact, I would say the story going forward is going to be less and less about the first generation ethanol being produced from sugar and molasses, and it is going to be about second generation, where it will be produced from agri residue, forest residue, and those kind of feedstock. So the company in question that you're talking about, or in general the biofuel story of India, is more about multi-feedstock and multi-output. So I don't think this is anything more than a minor blip in the current numbers.
Oh.
No, so nothing changes in that sense, because I mean, the point is you would also have to bet on. There are various ways, right, in which this transition will take place. So in that sense, I mean, again, as you said, don't want to press you on stocks or anything, but you would continue to believe in the names that you own. You would probably add more at lower levels.
So, Prashant, energy transition remains one theme that we very strongly believe in. World has no choice but to move away from fossil fuels, move towards renewables, and move towards circular bioeconomy, essentially using more feedstocks which can be recycled. So I don't think there is a choice as a humanity that we have. But it is various technologies are at various stages in terms of commercialization, in terms of adaptation. So there will be fits and start, no doubt, and there will be times when there might be tightness in the older technologies like fossil fuel as well, which can go into shortage. But it is more likely to be a shorter-term phenomena than anything. Over a longer-term period, we have no choice but to move towards newer technologies. So in that sense, for example, second-generation ethanol is still a technology that is not commercially viable. But at the same time, the motivation remains high. The intent of the governments, the policies, and the money that will flow towards this eventually has to bring the cost down. So we are moving toward in that direction, but it will probably take some time. Sustainable aviation fuel is another technology. For example, even electric vehicle requires a lot of infrastructure build up before the adaptation can start. So I think various technologies are at various stages of adoption.
By the way, the market is picking up now, so don't lose sight of that. The Nifty is now above the 21,000 mark quite effortlessly, actually. It's building onto its gains. The Bank Nifty is the one that's charging ahead, 0.5% higher. So, we had spoken about this last week as to how now the Bank Nifty has to perform for the Nifty to stay well above 21,000, and that's pretty much what's happening. It was a 5.5% rally on the Bank Nifty last week, and now it's piling on some more weight. Ravi, hi, good morning, and thanks for joining in. You think now the time has come for some of these heavyweights, HDFC Bank, Axis Banks of the world, that haven't done anything in 2023? You think the time has come for them to perform, and how are you feeling about this space now?
Morning, Sonia. I think I do tend to agree with your assessment over there that the time has come, and allow me a few minutes to explain why I feel so. Post-COVID, we actually did a great job managing COVID as well as managing the balance sheet. The result of, at that point of time, we were all cribbing that, government is not doing enough to provide fiscal stimulus to help the economy revive. But today we are in a better position because we didn't bloat our balance sheet at that point of time. So our inflation is also in check and our balance sheet is also still not out of shape, which most of the developed world is facing today. So from that point of view, India was already a relative outperformer in the world. But most of this relative outperformance was driven by domestic flows. Now that is going to change going forward. One of the reasons why the foreign flows were kind of not coming to India was kind of uncertainty. We are too close to the central elections for next year, and there was uncertainty regarding whether there will be political continuity and stability or no. Markets, like stability and continuity. So post the assembly elections, it has kind of the probability has moved in favor of continuity and stability, and that is why the markets are actually responding to that. FII positioning overall in the market, in the cash market, is at the lowest level ever. They own only about 16.6% of the Indian equities, which is a decadal low. Positioning on the derivatives market side has also been till very recently on the short side. Last 2 weeks have seen inflows of about $3 billion come in. And I think this is just the beginning of a longer term trend. And whenever FII flows come in, it eventually flows into the large sectors like financials and IT, because that is the space that bore the brunt of the flows going out. Now that is going to be the beneficiary of the flows coming in.
Okay. Now my question was more about specifically for the banks. So, this banks versus IT argument, right, that we generally have. Do you think banks will now take center stage, at least in the first half of the new calendar year? And if yes, do you stick with the larger banks, the HDFC banks of the world?
So, absolutely right. The larger banks, larger private banks are available at a really, really attractive valuation from a 5-7 year perspective. And this space still remains relatively a high growth area. 18-20% growth for some of the large banks is a very commendable growth over the next 3 to 4 year horizon. And when you look at the financial space globally, you will not find too many financial companies growing at this kind of a rate. So from a relative perspective, maybe there are some smaller banks which can grow faster, and don't rule that out. But this is the best risk reward available in the market, in my opinion, where money is easily going to flow into this sector, and there is going to be an outperformance of the large private banks going forward.
Okay, Ravi, just another theme which has done phenomenally well, which is PSUs, right? And it's been described as the leader of this bull market, and it has been so far, and perhaps many believe it will continue to be. What are your thoughts there, and what are the PSUs, of course, is the common thread across a range of companies in different sectors. But do you believe that? And where do you find the maximum opportunities from here in that space?
See, I am not a believer in that a particular sector should go up because it is owned by government. No, there are certain, even within PSUs, there are different themes. One is, kind of extremely cheap valuation. Second is some improvement of some efficiencies. And third is there are some businesses which are almost monopolistic in nature. So we are more tilted towards businesses which are more monopolistic in nature rather than towards kind of a reversion to mean trade, because the valuations were very attractive. Yes, it's a rising cycle, and usually all the companies tend to do well in that space. So even a company that does not have any kind of a competitive advantage in a rising scenario will do well. But there will come a time where, as you were mentioning before we started speaking, that there will be separation of men and boys going forward, because the NIM pressure will start showing the I'm talking about the bank specifically, but ability to gather CASA, ability to open up branches, execution, ability to adapt to the new digital age, all that will come into the reckoning going forward. Also, some of the PSU banks are actually levered almost 15-18x, and it is not a choice for them. Yes, the first QIP for the PSU bank got off to a flying start. They got a lot of demand, but it is more a need, and it is not a luxury. They are raising capital to reduce their leverage. It is not the growth capital that they have. So I am not going to paint every PSU with the same brush that, okay, it's a PSU, this is the market of PSUs, let's buy PSUs. I have to be first excited about the business. Then it doesn't matter to me whether the business is owned by government or is it privately owned.
All right. By the way, just want to mention that the grand old index, the Sensex, has hit that 70,000 mark. So big milestones really coming through. We generally look at the Nifty we scrutinize the Nifty, but don't forget that the grand old index, the Sensex, also hit that milestone of 70,000. Ravi, I know you track the pharma space very closely, so I wanted your thoughts on what's happening with Dr. Reddy's. There is this US FDA note that has come through, and some of the observations seem like they're severe, according to some analysts. But if someone holds on to Dr. Reddy's for the long term, should they be worried?
So, Sonia, I won't be able to comment on a specific stock, but I can tell you, yes, there are some issues with the FDA compliance, and the FDA tends to constantly keep increasing the bar. So I'm not saying that these are bad companies or there are lapses, of course, but the goalpost has also been constantly moving higher and higher. So won't blame the Indian companies too much, but the main problem over in the pharma space is not that they have US FDA compliance issues, but it is also to do with the fact that the competitive intensity has been tremendous in this space. The buyers have consolidated in US and the sellers are actually fragmented. So the buying power has shifted in favor of the buyers. So the base business that these companies have of the oral solid generics constantly keep deteriorating on an annual basis by anywhere between 8 to 10%. So they need to introduce new products just to stay in the same place. And the problem with the Indian pharma space is that they have not invested enough in innovative R&D to be able to replace that pipeline of drugs with some blockbuster products that can take them through. There are some one-odd complex generics or one-odd inhaler or bio-generic opportunities, but no NCEs or great innovation coming out of India yet. And that has been a bugbear where their dependence on the commodity business still remains very high.
All right, Ravi, it was great talking to you. Always good to learn from you. Thanks a lot for joining in. Have a good week ahead and a great year ahead as well. Happy New Year to you and your team in advance. Thanks for being with us on the channel. Let's move on now. The market is doing not too much, absolutely flat with a bit of a positive bias. But one space has been in focus, which is the commercial vehicle space. Ashok Leyland is the company on our radar. For November, the company saw a 3% year-on-year decline in wholesale sales, while the medium and heavy commercial space declined 10%. To discuss how demand is shaping up here onwards, we have Shenu Agarwal, the Managing Director and Chief Executive Officer at Ashok Leyland, joining us now. Mr. Agarwal, good morning and thanks a lot for joining in. November saw a year-on-year decline in commercial vehicle volumes, not just for Leyland, but for peers as well. I want to understand, was there any kind of one-off impact in November, or do you expect to see this decline continue in the months to come? What are the demand trends looking like now?
No, we think we are very, very optimistic about the industry. I think November was just a blip, one-off blip in the market. I think just a combination of a few factors. I think elections was one where in the states which were undergoing elections, we saw a slight dip in the retail demand. I think it is temporary and it will come back. I think there was some corrections in the retail, in the inventory as well. Yeah, but all these are temporary. December already, we are like already into December and it is looking very, very good. Also, quarter four, we are very optimistic about the demand overall.
Can you give us some numbers? When you say you're very optimistic about the demand, what kind of growth do you see for the industry by the end of FY24? And what is the reasonable assumption for FY25, both for the industry as well as for Ashok Leyland?
See, for FY25, it will be too early. I think give us a couple of more months and we'll get back to you on FY25. But for FY24, the current year, when the year started, we said MHCV industry might grow by about 8 to 9%. We are still sticking to that forecast for the year. So far, industry has actually done better than that forecast. But I think overall industry should be about 8 to 9% range in terms of growth over last year for FY24. As far as LCV industry is concerned, we had said in the beginning of the year that it might grow by 4 to 5%, which has not happened so far. But still, we are very hopeful that even LCV industry might come back in the balance 4 months, and we will see a positive growth in LCV side as well.
All right. Hi, good morning, Mr. Agarwal, and thanks so much for joining in. Well, we have Tata Motors over the weekend. They have said they're going to be taking a price increase. Do you have similar plans as well? Are you looking to push through a price increase? Point number one. And point number two, from August onwards, the discounting seems to have gone up. What is the current situation?
Okay, on the price increase, yes, we have heard that Tata has announced a 3% hike for commercial vehicles pricing from 1st of January. We have not decided on the price increase as yet. But yeah, the fact remains that, over the last couple of years, the amount of input cost that has increased, we have not been able to pass it on to the market completely. So there is a need for a price hike. As soon as we take a decision, we'll also announce that. As far as the discounting is concerned, I don't think there has been a major shift in discounting in August or after August. I think the discounting levels are quite consistent with what we have seen in the past in the industry. So we are quite hopeful. Actually, what we are actually focusing on is getting more and more pricing power through better products. There's a lot of focus that we are putting on product segments, especially where we are not very, very strong. Yeah, okay. So that is actually helping us quite a lot.
Got it. So you've cleared the air on that front. The other big headline today is about the mandatory cabin AC from October 2025. I want to understand from you, how much can the cost increase go up by on this? And for the industry on the whole, what is the penetration as of now?
See, the cost increase won't be that high. I think it would be still within the range of 1 to 1.5%, right? So industry is actually welcoming this step because it will really help in terms of efficiency and productivity of the vehicles that we have on the road or will be there in the future. So I think it is a welcome step. So yeah, the date is 1st of October 2025, which is quite far away. But yes, we shall be ready with these new regulations.
What is the penetration as of now for the industry, for your company?
Penetration right now is very, very small. I think it is like less than 10%. Yeah, so with this mandate coming in, I think the penetration would really jump from that time onwards.
Mr. Agarwal, so between LCVs and medium and heavy commercial vehicles, what is the volume split for you? I mean, on an average, if you can tell us, because on LCVs, I think most are projecting a small degrowth. Although last 4 months, as you said, maybe things will pick up. And is there going to be any change in strategy? And what are some of the drivers that you see for both markets as we head into FY25?
Yeah, so on the LCV side, see, in the long term, we are very, very bullish about the LCV market. Whatever is happening in the country in terms of infrastructure improvement, in terms of consumption patterns, etc., those are very good signs for LCV market. LCV is kind of a last mile delivery vehicle. Yeah, and therefore that market, as you can understand, will grow leaps and bounds into the future. So although there is a small kind of aberration this year that LCV market is not growing so far, while we are still hoping that it will show some positive momentum going forward in the balance 4 months, but it is possible that LCV market may end up at the same level as last year. But I think strategically, it does not deviate us from focusing on LCV because, as I said, in the long term, LCV is a big play for us. We still have only 20% market share. We operate in a particular segment in LCV. So for us, it is both about expanding our product range as well as gunning for more market share in the LCV.
And how does your own volume split, sir, between light commercial vehicles and M&HCV?
So volume split, it's not right to compare the volumes, but because the average price or the average realization of a LCV would be like less than half of MHCV. But still, the volume split would be roughly, let us say, 70-30, 70 for MHCV.
Okay, since 70% of your business is for MHCVs, let's talk about that business a little more. You were talking about an 8 to 9% overall growth for the industry. What would the MHCV growth be for the industry? What would it be for your own business by the end of FY24? And when do you think you'll get to that targeted market share of 35% that you had guided for earlier?
Like I said, for the current year, we are expecting MHCV market to grow somewhere in 8 to 9% range. Of course, Ashok Leyland wants to do better than the industry, as we have been doing so far. We are at roughly 30% market share right now. We are improving on it as we go along. 35% is our medium-term target, which we want to achieve in the next 2 to 3 years.
Okay, so 35% market share is what you'll achieve in the MHCV space in the next 2 to 3 years. Got it. In terms of margins, I wanted to understand, because you had given a target of double-digit EBITDA margins in the near term and mid-teens in the medium term. Now, you've already hit 11.2% margins as of the last quarter. By when do you think you'll be able to reach that mid-teens margin level? Do you think you can achieve it by the end of FY24, maybe early FY25 itself?
No, that will take a little bit longer. That mid-teen target, we had said that again, that would be about 3 to 4 years later. But this year, we are very happy with the performance of our margins. We thought that we will end the year at double digit, but we were very fortunate to have double digit EBITDA margins in the first quarter itself. Like you said, last quarter, we were at 11.2. Of course, the mantra for Ashok Leyland is profitable growth. So we are very finely balancing our market share and profitability aspirations.
Okay, all right. Mr. Agarwal, what about defense? In the first half of the year, I think revenues were around 300 crores, if I'm not mistaken. And for the year, I think you were guiding for 800 to around 1,000 crores. Is that on?
Yeah, that is very much on. In fact, we already have very substantial amount of orders. We also have a very strong order pipeline actually for FY25. So defense business is doing very, very well, and I think it will continue to do so at least for the next 2 to 3 years.
So 1,000 crores is on the cards for this year?
Yeah, I said 800 to 1,000 crores. So we are pushing it to be 1,000, but definitely we'll achieve 800.
What about on EV? You all had plans. I think the capital outlay that we're looking at was around 1,000 crores. You could tell us what is the updated number out there on the EV part of the business, and how do you fund it? Will you look to dilute some stake? What is the funding plan basically?
No. There is no funding plan as such for Ashok Leyland. Ashok Leyland cash position, debt position is very good actually right now. Our debt equity is roughly at about 0.1 to 0.2. Yeah, so there is enough ability to raise capital. Now, for FY24, our capex would be somewhere around, let us say, 500 to 750 crore range. And this includes all the investments that we are doing on EV and other alternative fuels. Now, as far as electric buses and electric light commercial vehicles are concerned, you know that we have a subsidiary company called Switch, in which all the activities related to those two product segments are happening. And that company is being funded by Ashok Leyland itself right now.
Okay. On this topic of EVs, right, there is a news report suggesting that the US is going to back a bid by the government to introduce 50,000 EVs on its roads by 2027. There's a joint $400 million funding that the US and India are looking at together. Can you give us the latest on that, whatever you know, and how will Ashok Leyland be able to contribute to that?
Yeah, see, as far as, I know this is something of sort of a fund that US and India are creating to provide a payment security mechanism for all the GCC contracts that government wants to push. to bring adoption of electric buses into public transports. So I think industry has been asking for this for a very long time, and now it seems to be happening. So we are yet to get more details. But I think this is a great step in the direction of adoption of electric buses in public transport. Government has this mission of putting 50,000 buses on the roads for public transport. And I think something like this would immensely help it.
Okay. Mr. Agarwal, thank you very much for joining us. It's a pleasure having you with us here on CNBC TV18. And thanks indeed for taking out the time and coming on. Well, we'll get a quick look at the market. 10 points higher is what we have, 20,980. We take a quick commercial break here, and we'll come back with more on the other side. Stay with us.
CNBC TV18, embarking on a quarter century of excellence. CNBC TV18, embarking on a quarter century of excellence.
Welcome back. Well, as we bid goodbye to 2023 in a few days from now, it's time for our special offering. The big winners of 2023 will be focusing on stocks which have really shown a very stellar show in this year. Today, we're focusing on Birla Corp. The stock is up more than 40% in 2023. Mr. Sandeep Ghosh, the Managing Director as well as the Chief Executive Officer, joins us on the show. Hi, good morning, Sandeep. Thanks so much for joining in. And congratulations, your shareholders are very, very happy. You know, at the start of this year, you had valuation comfort. Now, that seems to have trimmed down a little bit because now the stock trades at more than $90 per ton on an EV per ton basis. So the outlook is going to be important. Tell us a couple of numbers. One is on the volume parameter. You all were guiding for around a 15% growth in terms of volumes for the year. Do you maintain that? And also for the year, the EBITDA per ton, you all were talking about 850 rupees per ton. That would mean the second half of the year has to be far better. Do you stick to both these two numbers?
Volume we definitely stick to. I don't see any reason for volume being, under pressure or threat, because our volumes are based on, both the market projection as well as our own internal, some of the capacity additions which had come up and the scaling up which is happening especially in our down south in the Mukutban plant in the central Vidarbha region. Well, that's so I think volume we are very comfortable. EBITDA we indicated about 850, closer to 850, and we have so far the assumptions on which it was based, we don't have any reasons to revise it. We'll take a closer look towards the end of the year, but so far I think all the indications, both for us and the industry, I think are moving in the right direction. Everybody, I think, has based things on a fairly conservative plane this year, especially on the prices front. And so there, I think that's why we are sticking to our projection, because we don't see a major disruption in the market.
Okay, the reason I ask you is because second half of the year, you'll have to do nearly 1,000 rupees per ton to get that average to around 850 rupees. For the time being, you're appearing fairly confident. I wanted to ask you about, since you have your core focus would be on states like MP as well as UP, and MP went for an election. So was there any slowdown in terms of demand? Did you experience that? And also, since I've been tracking the cement space for a while, Central India is getting very, very competitive. Do you believe so as well?
See, yeah, it is getting competitive. There is a pressure on capacity utilization of most players, but there, I think we are reasonably more comfortably placed, without getting complacent about it, is because our factories have been running in Central India at 95% plus capacity utilization. And we are therefore not really in a volume game. We are focused, in our chosen segment and the geography where we expect to retain our market share, both in value terms as well as in volume terms. Why I say value terms is, we are a very uniquely placed company where we have got almost 50% of our volume coming from the premium end, another 50% coming from the value end, which is very distinct from other cement makers who are present by and large either only on the premium end or on the value end. So they face the competition in each segment, in isolation. Whereas we are able to straddle between the two segments, and with a relatively, robust but smaller market share, we are about 20% in our core markets in those areas. And with a strong brand equity, plus, I would say, very strong go-to-market assets in terms of sales and distribution, in terms of our people, logistics capabilities. So that's where we expect to hold on to our own.
So, Mr. Ghosh, you said volume guidance 15% for FY24. Can you also help us with some numbers on the EBITDA front? Earlier, you had guided for an EBITDA per ton of 850 rupees. So, do you think you can maintain that for a full year of FY24? Or given the kind of pressure, perhaps there could be some dip there as well. And if you can give us an early indication of what FY25 could look like in terms of an EBITDA per ton?
I wouldn't go into FY25 just now. FY24, I just mentioned to your on the show earlier that we are staying by our indication of closer to 850. We don't have reasons to change it just now because there are certain upsides and tailwinds which we have assumed in and which so far seem to be on track.
Can you also give us some indication of what debt would look like? There is 1,000 crore capex that you have in this year. So the concern is that the debt may not come down. What is the expectation of net debt by the end of... Yeah, go ahead.
We're not expecting debt figures to change just now. That's why we are not going in for any major capex expansion. Our current, priorities is scaling up to Mukutband, which is our new facility, which was earlier delayed due to COVID and various other factors. It's ramping up. But right now, we are tracking very much as per our expectation and what we have projected. We are very happy with the scale up which is happening there. So by the end of the year, that will put us on a firm footing. Meanwhile, we'll obviously not compromise on our sustenance capex. And then going forward next year, we've already announced our first new grinding unit in UP. We'll go for that.
Okay, all right. But debt will not come down from these levels?
At this moment, we are not looking at debt coming down significantly.
Got it. Final question then. What about inorganic growth? At Kesram Industries that went into the Ultratech fold, did you all have a look at that asset? And I can see a smile on your face. So I want to know your plans in inorganic growth. You're already at around 20 million tons. As you said, you'll have laid out a couple of grinding units as well as some clinker. Where do you see you headed to? And also, if you have to go for inorganic growth, what is the ticket size you look at?
We are not looking specifically at inorganic growth. We have been very, very, I think, transparent in our, statement of our intent. Our objective is to get from 20 million ton to 25 million ton in 26, 27. And at the moment, we see that happening primarily from organic growth. And that path has been laid out. We are going to our next big ticket expenditure would be line 2 in Maihar, which is the Reliance unit which we had acquired. It is all laid out for the second line expansion, and that's what we are going to do, almost equal size. Prior to that, we will put some grinding facilities in place, and the first step towards that is UP, which we just mentioned.
Got it.
So at the moment, we are not, unless something comes very attractive, we are not looking at anything inorganic aggressively.
Okay, all right. We'll leave it there, sir. Thank you very much for joining us, and it's a pleasure getting those details from you, for our viewers. Thank you very much indeed. Well, let's talk about the next story, and this is a big one. The Ministry of Commerce and Industry has amended the Special Economic Zone regulations. Industry experts expect the new regulations to allow SEZ areas to be leased faster in the future, helping occupancy levels. To discuss what do these new SEZ amendments mean for the industry and what's the outlook basically from here out for the companies involved, we have Arvind Maya, Chief Executive Officer at Embassy REIT, and Ram Chandani, Managing Director, Advisory and Transaction Services India at CBRE. Gentlemen, great to have both of you here. Appreciate your time. Prashant this side. Arvind, if I can start by asking you, what will this mean for your business? I mean, what is the vacancy, in the SEZ portfolio that you operate, and do you see an improvement in occupancies because of this notification?
Yeah, sure. Thanks. Good morning, Prashant. Thanks for having me on the show. Big picture, I think very positive for the sector. High-level numbers taken by IPCs. There's about 300 million square feet of SEZ space, of which around 20% is vacant as of today. The numbers growing. So what that means is this entire space becomes marketable as of now. So from a commercial real estate, anyway, we're already seeing growth in the form of global captives taking a lot of space. With this SEZ regulations out of the window, I think we'll have a twin growth engines to take our occupancy up to higher numbers.
Okay. Arvind, this 20% number, has it been increasing over the years? Has it been coming off? I mean, what has been the trend, and what will this do? I mean, how much will this sort of go down by vacancy? Yeah.
Sure. I think to give you a sense, I'll take our REIT as an example. In the past, we used to have close to 50% of the new lease up from in the form of SEZ space. That's now dropped to around 15 to 20%, right? That's caused as and when leases are coming up for renewal, people want more non-SEZ space. We can speak about it in some time as to the reasons as to why that's happening. But the space is going on increasing. It's moved up from, say, 10% to 20%, expected to go up further. But with this new regulations, effectively, we can market this space as a non-SEZ, subject to we demarcating it as NPA. So this should be able to kind of stem the increase in non-SEZ spaces.
Okay.
Or rather, SEZ spaces.
Sure. Ram Chandani is also with us of CBRE. Ram, your thoughts on these amendments that have come through? What kind of boost would this give to demand for commercial real estate?
I think stemming back, thanks for having me over. Stemming back from what Arvind mentioned with the 20% vacancy, that's approximately 38.5 million square feet of vacant space across the country, across the 7 major markets. I think the big opportunity is that occupiers who were not following the SEZ regime from the 2020 sunset clause, I think this gives occupiers an opportunity to go ahead and look at that space and co-locate their SEZ operations alongside their non-SEZ operations. That's one big plus. The second part is that with the growth of the office market again in India post the 2 odd years of COVID, we've seen absorption levels last year hit the 55 million square feet. This year again, we expect the year to close at 55 million square feet plus. I think the opportunity is that this is all quality commercial grade office, right? It's grade A office. I think this gives the opportunity for occupiers to consider these who are not working under the SEZ regime. And this is great quality space that's been lying vacant. Obviously, it makes life easier for them who don't fall in that regulatory environment of following an SEZ unit for their growth. And this will boost the overall leasing levels, because in some of the key micro markets in India, there's a lack of quality of grade A supply. I think this will help occupiers to consider that space.
Got it. Thanks for that. Arvind, just to come back, so you said those reasons why newer people who've been coming in have been not coming into SEZ. Briefly, if you can lay them out. And second, with this change, how fast will the pickup be? Or will it take a lot of time to find new tenants, etc.? Go on.
I think in terms of what's happened is, historically, it was largely growth from tech occupiers taking up space in SEZ. 2020, sunset came into picture. Post that, of course, there's been the interest rate hike, and then IT industry slowdown. So IT as a sector has not been taking a lot of space. Rather, they've been giving up space as a part of their portfolio rationalization. all the new space take-up are from global captives, and they don't want a SEZ space because, one, they don't have any direct tax benefit, and two, more importantly, they don't want to be in the physical constraints of a SEZ where there are a lot of regulations, because of which the new age occupiers prefer a non-SEZ space. That's the reason why the demand for SEZ space reduced over a period of time. So that's the answer to your first question. And in terms of timeline, I think we need to wait a bit, because while the regulations have come out, and they've said that it requires a board of approvals, that's a BOA of SEZ, to sign off on this demarcation. What's the real SOP for it? I think we are waiting for that from government. We as an industry have represented for a single window clearance so that it becomes a much smoother and faster process. So we have to give it some time for the SOP to be in place.
Got it. Ram, I wanted your thoughts on the overall commercial real estate space and the kind of realizations, right? Because if you look at residential property prices, they've risen about 20-25% across cities. But commercial or office rentals are largely flat if you map it over a 6 to 12-month period. Why do you think that is? And what's your own view on how things may shape up in terms of office rentals?
One of the major reasons why our office rentals have remained fairly flattish is it's a supply-demand story, right? Obviously, with 2 years of COVID, where the absorption levels were much lower. Last year was a good comeback year. This year, as a follow-through in 23, has been a great year in terms of expansion, not just from the banking financial services sector. We've seen engineering, manufacturing sector, their GCCs expand here. The healthcare sector has dramatically seen growth. I think overall, for India being a large offshoring innovation hub for a lot of occupiers, I think the talent base over here is the biggest attractor for us in India. And that's really driving the growth for us in India. And if you look at the rental numbers, we've seen quality parks and micro locations that have accessibility to infrastructure, social infrastructure, amenities, etc., are the ones that are attracting the occupiers. If you create that energy in your park environments, in your business park environments, you have proximity to public transport, I think those are the parks that will see the growth. And that's what we're seeing across India. Whether you look at NCR, whether you look at markets like Bangalore, Chennai, Hyderabad, Mumbai, Pune, all these key markets have seen growth.
Yeah.
And this will continue to grow. I think amenitization of space is important. And just the employee experience that you create in these environments will be the biggest attractor for attracting tenants in these parks.
Arvind, same question to you in terms of sort of rentals and pricing. What's the expectation? What should we expect as we head into 24? One. Second, what is the SEZ sort of, what is the SEZ share as a part of your total office portfolio? That is second. And what kind of impact do you see to your earnings going forward as this sort of starts to become clearer and you're able to, give this space out in SEZs to newer tenants?
Sure. I think in terms of pricing, we've already seen the price go up over the last 12 months in the key cities like Bangalore, Hyderabad, Chennai. That's largely, as I said, because of increasing space take-up by global captives who want the best of amenities, which is what we offer, and they're not really very price conscious. They need the best of space. I believe with this, the demand for non-SEZ also going up, rather the SEZ converted to non-SEZ going up, we believe that the price should go up even further in the coming years. Just in terms of our portfolio, we have close to around 55% of our portfolio in the form of SEZ. And over a period of time, we see a lot more of these spaces getting converted to non-SEZ as the old occupiers give up space. What it means in terms of our earnings, I think we did clearly mention as a part of last quarter earnings that we believe the occupancy has bottomed out now. We were around 83% last quarter. Pre-COVID, we were close to 95%. This kind of gives a clear path for us to move the occupancy from 83 to 95, which logically should take the earnings up and the distributions up in the coming years. Would refrain from giving any specific guidance on the numbers, but clear growth path available for us in the next few years.
All right, we'll leave it at that. Thanks a lot for joining in. Appreciate your thoughts. Well, let's get back to the market now, which is looking pretty fine. So 21,000 is holding quite firm. Mitesh Thakkar is with us. Mitesh, do you think we can build on to these gains for the rest of the day? And what are the stocks that you're looking at?
So good morning again. I think the trend remains on the upside. So I think there's a good chance that next few days will be positively biased and intra dips will be bought in. So maintain a positive stance. On the stock side, I have a buy on Kotak Bank. A disclaimer that we have recommended this to our clients, so there's vested interest, but buy with the stop at 1840. Look for targets of 1895. And the other one which I like is PVR. I think PVR is also giving a good price and volume breakout today. So buy here with a stop at 1765 for targets of 1820.
All right, let's slip into a quick break on that note. On the other side of the break, we'll talk about the commodity space. Manisha Gupta will join in. Do stay tuned in.
CNBC-TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
All right, we have a focus on the commodity markets now. Manisha Gupta is joining in to tell us what she's looking at. Manisha, good morning.
Morning, Sonia. Thank you for that. I want to talk about gold because we've seen the prices very, very volatile. We saw an all-time highs and a very big correction from there. You know, the all-time high that we've seen in this year has been $2,150, and we're just about holding around that $2,000 per barrel mark, per ounce mark, I beg your pardon. So $150 of a decline is what we've seen. But more importantly, what I'm focusing on is the sovereign gold bonds. The markets were hoping that they would be launched around Dhanteras or Diwali, but all of that just passed away. And now we have seen two tranches being launched right now. One is in December between 18 to 22nd, and the second is in February that comes in on between 12 to 16 in 2024. Up until now, we have 67 tranches, including all of this being launched into the markets there. And the first tranche, remember, was launched in 2015. We did see that being launched at around 2,400 rupees per 10 grams per gram of a mark, and that redemption has happened in case of 6,000 rupees on the higher side. So a big 128% of gain coming in from that one. More importantly, total holding until now has been at 118 tons, and this is after the redemption of 2 tons that we've seen of the 2015 tranche as of now. I mean, this is one instrument within gold that has garnered a lot of interest and excitement, and we have seen record buying happen within the calendar year of 2023 as well. I just quickly want to take you through some benefits here, because this is something that the government is pushing quite strongly. So when you buy a sovereign gold bond, it's 24 carats. That is, it's 99.9% purity of gold that you see. The maximum subscription that you can take is of 4 kgs within a fiscal year, whether you are an individual or an HUF. If you are an institute, then you can buy until 20 kgs in a financial year there. 2.5% per annum is something that the markets clearly are rejoicing about, because even as gold prices have gained so much, 2.5% of an interest is what you gain every year there. Also, when you look at sovereign gold bonds, they are eligible to be put into a demat form. It also, you get a certification of holding when you buy into SGBs. The other important thing is when you're buying it online, you get a discount of 50 rupees per gram there. And most importantly, there is interest on SGBs taxable, but the capital tax gain is something that this is exempted from. The markets also do see that this can be used as a collateral for loan as well. And that is the reason that you have seen huge holdings into this one, 118 tons at this point in time.
All right, Manisha, thanks a lot for that. Well, just want to leave you with one chart, the chart of IRDA. Now, we've been talking about how the entire renewable energy space is doing exceptionally well. IRDA is now up 15%. This is on the back of a huge rally that the stock has seen post-listing. So the stock of IRDA should come up for you. There you have it, 15% rally there, a big run in that entire space. Let's slip into a quick break. On the other side, our special segment, it's the economy. Lata will get chatting with Digant Haria of Green Edge Wealth Services and Karthik Srinivasan of ICRA to put focus on the NBFCs and the PSU banks along with the fintech lenders. Stay tuned.
CNBC-TV18, embarking on a quarter-century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Today we focus on some banking and finance stocks. First up is the 30% fall in Paytm shares, 197 Communication, after the company said it will reduce small ticket loans of under 50,000 rupees. This follows, of course, the Reserve Bank raising risk weights on unsecured loans. Secondly, the big news in BFSI, Bank of India has stormed the QIP market with a 4,500 crore QIP issue, which has been subscribed 4.11 times, leading to a steaming rally in PSU bank shares. The list will come up for you. Already they are up about 30 to 50% year to date, but month to date, all of them have been seeing about 9 to 10% gains. That's the month of December. To examine all these three sectors, fintech lenders, NBFCs and PSU banks, I have with me Karthik Srinivasan, Senior Vice President and Group Head Financial Sector at ICRA, and Digant Haria, the co-founder at Green Edge Wealth Services. Thank you very much, Karthik and Digant, for joining us. Digant is also, in his previous avatar, a renowned expert on the financial sector, BFSI space. So, Digant, let me start with you on Paytm shares. The company made it very clear in the conference call that they're moving out of small ticket loans, but they will redouble their efforts on larger personal loans. But the market has given it a severe punishment. Do you think all the bad news is in the price?
I think a lot of the bad news is in the price, Lata, because see, Paytm does not have its own balance sheet. Okay, Paytm is dependent on, borrowing the balance sheets of players like, say, an Aditya Birla Capital or a Hero FinCorp or an IDFC Bank. And after the RBI diktat, it is only natural that those partners will say, hey, there's a lot of risk in BNPL and, let's go slow on the BNPL. So even if Paytm's own BNPL portfolio did not have a lot of problems, they are forced to slow down. So I think this is a risk associated with the asset-light model, that you don't have a choice when to grow or when to scale down your book. I think it's fair on Paytm's part to go slow because, the regulator has said that there are a lot of other small players who are not doing the right things in the sector. So it's fair, but I think Paytm is getting unduly punished for this. And I think, this punishment, in my view, only ends when it can have some of its own balance sheet, which is when it either applies for an NBFC license or an SFP license.
But is it only Paytm as a fintech which is impacted among the listed space? Not a similar problem for any other NBFC or fintech?
So see, Paytm is, directly impacted in a large way because it has huge presence in this unsecured lending segment, okay, which is the BNPL, unsecured personal loans and unsecured business loans. See, a lot of other NBFCs also do get impacted to a smaller extent. Someone like, say, a Fullerton or an Aditya Birla Capital, a lot of their growth came out of, the growth of Paytm. So those guys do get impacted, but see, they are more diversified. They can find their way around by growing in some other sectors. So, yeah, Paytm is the most impacted one.
Okay. Karthik, what's your sense? Paytm, a pure fintech lender, as Digant says, with lending out of other people's balance sheet is affected. But do you see any other areas, especially NBFCs, getting severely impacted?
Good morning, Lata. I mean, as Digant said, a segment where we clearly see some slowdown happening is the unsecured loan segment, driven by a couple of factors. One, last 2 years has been good, that this segment has seen significant growth, with larger players, with banks also looking at these segments to improve their overall margins and profitability. And also the India stack, which has helped them scale up quite smartly over the last 2 years. Now, with this regulations, we believe banks, NBFCs, fintechs are all reevaluating their strategy with respect to the business model. So till the time there is some clarity, we would see some slowdown. Entities which are specifically onto unsecured small ticket lending, possibly the slowdown could be more pronounced out there. For other players which have a fairly well diversified portfolio, yes, you would see some slowdown, on disbursement numbers with some of these entities disclosed every quarter. But at a portfolio level, the slowdown may not be that pronounced. But clearly, with RBI not only increasing the risk weight on unsecured loans, but also on lending to NBFCs, we believe that the funding to NBFCs could slow down, or in other words, bank may become a bit more choosy in their NBFC counterpart, which could lead to an overall slowdown in the NBFC AUM growth over the next 12 months.
Okay. Digant, any stocks you would pick out which could be impacted more than others in the NBFC space?
See, it should, I think the most impacted one obviously will be Paytm. And I think besides that, Lata, I don't see a very large impact on all the traditional lenders, lenders like, say, a Shriram Finance or a Mahindra Finance. A lot of them, started doing personal loans, but it is so small, Lata, that, it's very difficult.
That will not get impacted. They will get impacted because their loans from banks, as Karthik said, becomes expensive.
Yeah, but that's, the whole system gets impacted, so it eventually gets passed on to the borrower. Okay. So if somebody was saying, see, this is the first time RBI has done activity-based regulation. RBI has not made any differentiation between a personal loan given by a bank or an NBFC. So I think that activity-based regulation impacts everyone, and, everyone's funding cost goes up by, say, 20 bips. That gets passed on to the borrower. If it was just two players, it's difficult. But I think, I don't see a system-wide impact on everyone.
Okay. Well, it's not the first time they've done activity-based risk weights. This was the fashion between 2004 and 2008. Real estate lending, likewise capital market exposure, all those risk weights came in at that time. This is second avatar of macroprudential guidelines. Karthik, now to the other big one that has shaken the market in a positive way. Bank of India has come in with an eminently successful QIP. And we understand now our expert on the subject, Nimesh, has broken a couple of other banks which are lined up today and later on this week to raise QIPs. Does this mean a new lease of life for PSU banks? They're going to have more capital, and therefore, will you up their expectations of loan growth?
I need to just step back a minute out here. If you just look at the last couple of years, PSBs have had their set of challenges. Over the last 2.5 years, we've seen significant cleanup in the PSB balance sheet. Their capitalization profile has improved, and even the core operating profitability has improved quite sharply for most of them. So on the back of that and a conducive capital market environment, we have seen a couple of banks do equity raise, non-governmental equity raise. So from that point of view, it's definitely a good news that Bank of India has had a fairly successful QIP recently, and that clearly paves the road ahead for others also in case they decide to go on that path. Now,
Karthik, my pointed question is: everyone knew the cleanup, and all that was priced in. We are just showing the year-to-date gains. All of them have gained between 30 and 50% because this cleanup was known. But now, I didn't expect a spate of QIPs. One has started, two are following this week. So do you upgrade loan growth expectations or anything else?
Loan growth expectations would be difficult. One needs to also look at it that last 2 years, the banking system has grown at a fairly fast pace. And incrementally, if you look at the CD ratio is also pretty high. So unless the deposit base really goes up, it'll be very difficult to significantly upgrade on the loan growth for the system. Plus the RBI regulations, effectively shaves off about 50 to 100 basis points of an overall systemic growth rate. So one needs to just put things in perspective. Another thing which I would say is more than the growth rate, which should be more or less at similar levels, hopefully. ECL norms for banks are also around the corner. RBI hasn't set a date, maybe a year down the line or 2 years down the line. So it would be good that banks are actually much better prepared before that eventually kicks in.
Okay, what's your, let me toss the same thing to Digant. Digant, were you expecting this kind of capital raising by the PSU banks? I thought that was not factored in. Several other positives were. This makes their balance sheet healthy, even if not immediately making them, higher in the race for loan growth. How do you approach the space?
So, Lata, this PSU banks, I was expecting a spate of QIPs because, see, the government shareholding had gone to very high levels. In some banks, it is almost 95, 96% if you take LIC also together. So they had to come down to 75% someday. So now seeing these good capital markets, I think, Union Bank did a QIP. Now Bank of India has come for a QIP. I think they are also capitalizing on this boom. And they want to get their shareholding down to 75%. But I was really not expecting 4 times oversubscription. The excitement which I see around the PSU banks, that is really a surprise to me as well. And with this large capital, the natural inclination is to say, okay, now they can go out and grow. But, if we look at PSU banks, the 2 growth engines were lending to NBFCs and lending to retail. Especially a lot of people are starting about the retail thing. Now, both these engines have been, put a break by RBI to some extent. So upgrading the loan growth guidance, it does not look very easy. It's on, the only hope is that after elections, the corporate loan growth revives in a meaningful way. And that is when the growth guidance in these PSU banks go up. And that is when the re-rating happens. See, PFC, REC gave 1 quarter, 2 quarters of 20% growth and see how the stocks got, re-rated to levels we've not seen for decades. I think the same goes for the large PSU banks. They have to somehow give the confidence of more than 10% loan book growth, and then we'll, really see these valuations.
But you don't have any pick in the pack? Any pick in the pack?
No, so, all of, there are a lot of picks in the pack, Lata, but it's just that, we're waiting for the growth lever. Everything is fine, Lata. The asset quality is fine, profitability is fine, capital is fine. Only missing piece is the loan book growth. Once it comes, you see the valuations improve very meaningfully for them.
Yeah, as Karthik said, for that one should watch for the deposit growth as well, which also has been a far second to other maybe private sector lenders. Thank you very much, Karthik and Digant. Run out of time, not run out of questions. So probably there is something big waiting to happen in the PSU bank space. The rally also coincided with the 3 major states returning BJP governments. That also means that reassures a confident BJP government in 2024 in June, or at least that's the interpretation of the market. And that could mean some seminal changes in corporate governance, maybe some privatization for the PSU bank. So there's a whole gamut of things that's pushing up, but people are just waiting for things to happen. Maybe there's a rally here. We wrap up on Bazaar. On that note, Chartbusters coming up next.
CNBC-TV18, embarking on a quarter century of excellence.